Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. It has been 2 weeks since we last met, and in those 2 weeks, the first quarter has now come to an end, and today is the first day of the second quarter. And since Wall Street likes to take a look at things on a quarterly basis, we will talk a little bit about what happened and maybe what we can expect to happen next. And so let us begin the discussion on the investing in the economy with my panel of financial advisors and analysts. And as we go around the table, I would like to introduce them to you. The first one to introduce you to is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. Also with a seat at the table is Frank Rossetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a duo background in both finance and in software engineering, and you may have seen Kim in her many appearances on CNBC, Bloomberg, and also on Fox Business. And sitting in today for our regular panelist, Bob Fergasso, is Michael Godwin. Michael has a solid career in investing and is the chief investment officer for Fergasso Financial Advisors. And again this year, Fergasso Advisors is listed among the Barron's National Top 100 Independent Advisors. I want to thank all of you for joining us, especially you, Michael. Welcome back to our program. I hope you enjoy your stay here today. Now, before we begin our discussion, let me put some things in perspective in regards to the markets. It has been 5 months since the markets set their lows from their all-time highs. And since setting those lows in October, the markets have rebounded, gaining between 14 to 18%, depending on the indices from the lows. And the first quarter of this year has seen the NASDAQ up by nearly 17%, the S&P 500 up by 7%. The Dow, though, has barely made a move on a quarterly basis. So, Carrie, with the first quarter behind us, what do you think will be the biggest positives and negatives for the markets as we begin the second quarter?
Well, as we go into the second quarter, of course, this dialogue around inflation is top of mind for everyone. And we just had an announcement out that OPEC is surprisingly cutting production, which, just in one day of this, we're seeing the price of oil jump. So that doesn't really help the situation with inflation, but we'll have to see how that plays through. So I think that, the inflation issue is definitely a negative. Because we would continue to then see interest rates go up. And, the economy actually slowed in the fourth quarter, and we saw personal incomes, or personal spending rather, decline a bit in the quarter. So, interest rates going up in that environment, along with potentially bank tightening, really could be a headwind. As far as positives, and I know this sounds really counterintuitive, and I even hate to say it from a human perspective, but if we see the rate of unemployment go up, I think the markets will actually respond positively, because that is a sign that these interest rate increases that we've been seeing have been working.
Somebody jump in, go ahead.
So last week, we got some data on the economy, and it looks like the consumer is slowing down. The consumer did not spend as much as anticipated in February, and it looks like most of the measures of inflation are going in the right direction, just not as fast as we'd like it. So I think this is going to continue into the second quarter, and it's going to give the Fed pause. And I mean that they're just going to pause, not that they're going to be worried about things, but they're going to have an opportunity to pause. A couple of things are in their favor. The banks are going to be much more skeptical about lending because of their balance sheets and the price of treasuries. We could go into that, but let's just say we believe the banking system is safe, but banks may have a accounting issue. Most banks are going to be just fine. We'll put it that way. Anyhow, I don't want to go off into the weeds there, although I'm there right now. Anyhow, so I think companies are going to reset their expectations a little lower, but not meaningfully lower, because they had pretty soft expectations for this year. Earnings season is just around the corner, and I'm super psyched for it because we get tons of data. And I think that will set the tone for the remainder of the second quarter.
Looking backward a little bit, Stacy, the corporate earnings have been dropping off over the last quarter or two. And from where they were a year ago, I think they peaked out in the first quarter last year, and they've dropped 7 or 8% since then, and maybe 10, as much as 10 maybe, and across the board. And if that continues, it's going to be a headwind that I think that along with everything else, that's going to make it a little difficult for the markets to rise into that until there's some forward guidance that's telling us that we've bottomed out and we'll start heading north again. It will happen eventually. I just can't say whether it's around the corner or not.
Stacy, I can't really add too much to what Frank, Kimberly, and Carrie said. I would say on the negative side, as Kim mentioned, there could be more banking issues, and it doesn't really need to be a failure like Silicon Valley Bank. But a lot of these banks, as Kim mentioned, they just won't be lending as much going forward, and that's going to end up shaving some points off of GDP growth. And one of the bigger things is, to what Frank pointed out, is these interest rate hikes we've seen over the past year or so. The fastest pace of interest rate hikes since 1980. That takes about 12 to 18 months to end up working its way through the economy and onto companies' balance sheets. So I think you're going to start to see earnings of companies kind of shrink in the coming quarters. On the positive front, look, I don't think there's anybody out there who's really a strong bull in the market right now. So from a contrarian indicator, when everybody's bearish, sometimes it pays to be a little bit bullish. I don't think anybody thought the market would be up 7+ % to start the year right now. So it does pay to be invested a little bit. And I do think if inflation does come down while unemployment remains somewhat strong, that could help the Fed achieve their quote unquote soft landing style. I don't know if that's going to really happen or not, but I don't think it's going to happen, but that could be a bull case as well.
All right, I want to quickly go back and have each one of you say you agree or disagree. Kim, if I heard you correctly, you were saying you think the Fed will be making a pause soon and not be raising rates or necessarily dropping the rates at all. Michael, let's start with you. Do you agree with Kim?
Correct. I think there's probably the potential for one more rate hike, and then they should pause. I mean, the amount of damage that they could do to the economy on the banking side of things doesn't really warrant an aggressive hiking policy at this stage. All
right, Carrie, your quick thoughts?
I agree with Michael. I think we'll have one more and then they'll be done. Now the big question will be, when will they start to lower? As we sit here today, that's not really on my radar. However, if the consumer continues to slow and bank tightening continues to happen, who knows, we may get a cut by the end of the year, but I'm not counting on that.
All right, Frank, your quick thoughts.
I'm not sure we'll see one more. We may, but I'm looking at money supply a bit, and I see it's shrunk rather dramatically over the last 12 months. And that effectively is maybe a more significant tightening impact than mere interest rates by a quarter. So I'm thinking that other than this little oil surprise we're having right now, which may push inflation a little bit, I'm thinking that we're going to see inflation continue to trend downward. And therefore, I don't think they need to raise interest rates. I wouldn't be so sure that they're going to cut anytime soon, but raising them, I'm not sure there's much benefit to that.
All right, great. We've got all your thoughts on that, and we'll have to take a break, and we'll be back in just a moment.